Okay, start. Okay, I think it started recording.
Good. Yep.
Welcome everyone for our next edition of the Lofty Lunch and Learn. The purpose of these chats are to help more people learn angel investing and get oriented or continue to evolve as an early stage investor. Today, we're super lucky to have the co-founder and CEO of Techstars, David Cohen. Before we get to David, let me give a little bit of a background on what Lofty is and why we do this. So Lofty Ventures is the platform that I've built over the past decade to support the 180 plus founders at 100 startups that I've personally backed. Most of those are here in Chicago, but not exclusively. In fact, one of the outliers has a Techstars connection, Bridge. I'm sure you know Bridge, David, the email intro app. They're based out of Ireland, and now he's living in Switzerland. So that is very far afield for Lofty, but love the product. So the whole idea with Lofty Angels, which is our angel community, we're trying to help more people learn angel investing, came out of the idea that I don't see enough angels in Chicago and certainly beyond. I like to say I want to be first check, but not last check. And too often I make an investment, I try to share that with more angels, and it's hard to fill out the first round. So we're really trying to help fill the top of funnel and build more angels. And so we appreciate all of you being a part of this educational journey with us and together. And hopefully, over the coming years and over the coming decades, we can find and back more great founders. So if you haven't done so before, I will throw a link in the text chat. You're welcome to sign up for Lofty Angels. That's how you'll find out about more of this kind of stuff. You might have found it on a Facebook post or what have you. So please sign up for that. And also, we're going to be doing Q&A. So we're going to start off in a moment here. David will give a little bit of background on himself, and then we'll go into some questions between the two of us. And then we're going to open it up to the group. For the group, please send me direct messages in the text chat, and I will be consolidating and curating those, and then we'll be asking those with David in the last like 20 minutes or so. So with that, David, welcome. Thank you for joining us. Would love to get a little bit of your background on your journey and how you're back at Techstars and what's next.
Yeah, thanks, Chris, and hey, everybody. So I'll just start by saying if I sound extra sexy today, it's because I feel I have a little bit of a cold. And if I mute and lean to the side, that's just me coughing. So the good news is that you're on video, so you're not going to catch anything. So I'm David Cohen. I am based here in Boulder, Colorado. I've been here since 1995, but before that was in Florida. In Arizona for a little bit. I am 1-0, undefeated in job interviews in my life. Never lost a job interview, batting 1,000, so they like to say. So I basically only had one job in my life, and after that, I started starting companies. So just have a history of building various startups. Quick rundown of them. The first one was a public safety software company, did ambulance dispatch. That product, I was the CTO, the original coder, the hacker, if you will. And today, that software application is still used by lots of ambulance services around the world and has dispatched over 20 million ambulances, which is pretty crazy to think about. Did a couple other companies, one that failed, another that worked. Started dabbling in angel investing after having some exits and thought, man, this is a great way to turn a medium-sized fortune into a smaller one. That was my experience with it. So wanted to find a way to do that better, to do that with people that were good at it, to find some advantage around it. Meanwhile, I had moved to Boulder and really wanted to, make this startup community better. So the dual motivations of creating Techstars were to make the startup community here stronger and to find a better way to do angel investing. I thought, the way that most people were doing it kind of sucked and it needed to be unsucked. And that's, of course, why anyone creates a company or a startup is to unsuck something. So that was the idea behind Techstars. So it's been almost 19 years now since we started Techstars. I was the original managing director. Techstars is a accelerator program. I'm sure you've heard that term by now. That term was coined by my co-founder, Brad Feld. He came up with the word accelerator to describe this kind of activity. And of course, we've been on a long journey building Techstars over the years, have invested in right around 5,000 companies through the accelerator model. A couple $1 billion of AUM today, now an institutional platform where we're running the accelerator model and then following on in those companies as they grow and mature. We do that in, I don't know, 12 or 14 countries and 25 or 30 cities around the world, including Chicago. So great to see everybody. That's the quick background.
Love it. So we're going to jump right into a little bit more on Techstars and evolution here. Um, So also for full disclosure, I don't really LP very often, but I am an LP now into the Chicago fund that is going to be managing Techstars Chicago, Long Chicago. So just as a note there, but the reason I did that for our audience is I'm a deep believer in the community that Techstars has helped build and create in Chicago, all the way back to Troy building with Accelerate Labs before I moved back here in 2013, and then that evolving into Techstars Chicago. So big supporter of the local community. I'm very excited to hear how it's evolving with David coming back, and would love for you to give a little bit of an overview of how Techstars is evolved and how you're thinking about it here in Chicago.
Sure. So for those that don't know Techstars super well, I mean, we're basically a very active early stage software internet investor, and we've been doing that for a couple of decades now. As I mentioned, 5,000 or so companies, 22 published unicorns. There's a couple more out there that haven't said that yet. So we're sort of finding one or two a year, right, in the system. And then lots of other interesting companies have obviously come out of it. I think we're at about 450 or so exits in the portfolio, right? So quite a lot of activity and experience with early stage. I guess it'd be 5.5 years ago, I stepped back from a leadership position at Techstars and became chairman and led the search for a new team that would come in and sort of take over the direction of the company. That team was in place for about 4 years, and then about a year and 3 months ago, I came back as CEO again. So I'm now CEO of the company again after a stint as chairman, basically. And in that period of time where I was chairman, some of the decisions were made around sort of consolidating the platform, right? As you become institutional and kind of, managing a lot of money, right? There's sort of economic impacts that come at you and say, hey, we should really be investing more in, New York or Boston or San Francisco, right? And so some decisions were made to shut down a few markets that we were operating accelerators in, including where I live here in Boulder, and in places like Chicago and Toronto and a couple others in favor of investing more in kind of the largest markets. When I came back as CEO, that was one of the first things that I wanted to reverse in terms of that decision. I think that startup communities are what powers Techstars, right? And we're just a few hundred people, but the mentors, the alumni, that we work with are casts of tens of thousands of people, right? That want to help startups succeed around the world. So um, sort of started through an agenda of a few recommitments I made when I came back as CEO. One was to really squarely and clearly identify the customer and change all of our language. Our customer is not our LP, our customer is not our corporate partner, our customer is the founder. So we're here to help founders succeed. That's what we do. That was the first big recommitment. The second was to embrace startup communities. The startup communities that we operate inside of are wanting to grow and thrive, and we can help them do that, and they can help us with our investing activity at the same time. And that's much more powerful for the purpose of helping founders succeed. And third recommitment was, hey, bigger isn't better, better is better. Let's make this thing better every day for founders. So we've improved our investment offer. We've, in many ways, I think, made the experience better for founders in the last year or so. And a lot of those things are still coming to light. So that's kind of been the focus. We're very excited to be opening the doors again. We've been operating continuously in Chicago, but our Techstars Chicago sort of generic, open, non-verticalized program is going to be running again. Um, a little sneak peek. I think they're going to announce that in a couple of weeks. It's probably a fairly poorly kept secret in this community, but just so the local organization is a great group of people. Logan the Hive is leading there, and you can contact him to get involved with that in Chicago. And again, I think you'll see more public awareness of it in a couple of weeks. So, excited about that. We funded some fantastic companies in Chicago. Accelerate Labs. We have a long history with Troy and Sam and Farsht and all those folks. And so there's a long legacy of sort of us being a part of the Chicago entrepreneurial ecosystem, and we're excited to continue doing that.
Yeah, great. And I also personally have probably backed plus or minus a dozen Techstars companies. Good emphasis here in Chicago, but there are other locations as well. Chicago founders have bounced around too.
And it's a whole network, as you know, Chris. Like
Yeah.
it's a mafia, right? Des is starting a new fund, right? She's someone we funded in the past together, and Math Venture Partners, obviously we were involved in that as well. And it's a great network with a lot of tentacles. It's very global. And for those that aren't super familiar with it, right, it's an awesome way to do more angel investing because you're doing it with other great people around companies that, there's a context to do it together and learn about those companies through the accelerators. For me, accelerators are a great way to educate and improve the angel community in any city.
I would definitely agree with that. And it was seminal for me. I definitely met a number of people that I'm very close with today. I believe I met Amanda Lannert at one of the early demo days for Techstars, circa 14, 15, maybe. Uh, so those have been a huge part of my journey. And I think that's important to highlight too for all the angels and angel curious people that are on the call. If you're looking for more community around what you're doing, Techstars is a fantastic way to do that. And this is a great segue into my next question, which is how does Techstars typically work with individual angels? What are some of the ways that angels listening here could potentially get involved?
Yeah, so a few dimensions. One is that often angel investors have a strong operating background or history. And the way that Techstars works is we call it a mentorship-driven accelerator. And so I think there are something like 5 or 6,000 mentors across the Techstars system. And it sounds like a lot. They're obviously not all in Chicago, maybe a couple hundred or so in Chicago. But getting involved through mentorship, right? Volunteering to meet a company to try to be helpful in some way with a give first attitude, right? No expectation I'm going to get something back, but like maybe I can be helpful. That's what helps the startup community grow and thrive. And of course, you might identify a direct investment opportunity. There's never any pressure to invest, but by mentoring, it's a great way to kind of learn about the companies you're interested in. So, Techstars is picking generally 1 to 2% of applicants to the program. We see 20,000 unique applications a year globally. So, you can think of us as a pretty strong filter against all the stuff that's out there. And the way that a lot of angels think about it is, yeah, sure, I can get inbound deal flow all day long and try to keep up with my inbox, right? And try to advertise, that's how to reach me. Or I can just engage in something like Techstars and maybe other things that, someone is doing that filtering and maybe see stronger opportunities and do it with my peers, right? Do it with others in the ecosystem that are, mentoring or folks like yourself, which allows you to grow your own relationships. So that's one way through mentorship. Another way is, yeah, direct investing. The programs typically culminate with a demo day, which is just the company sort of celebrating, the end of the program and showing off what they're doing. The average Techstars portfolio company raises about $1 million just after the accelerator. So some raise five, some raise none, but $1 million is sort of typically what you'll see happen after the program. And you can just directly invest in those. We don't, charge any fees or, try to get in the middle of that in any way. Very open model in that sense. And of course, we institutional platforms. So people that want it to be more hands-off, we have LP arrangements. But for angel investing, it's more direct and through mentorship. I think that generally people find a path.
And a quick reflection too. I've been to many Techstars demo days, and one of the big benefits that you get in going to these demo days is, as an angel, we have to look at lots of companies to get conviction on the ones that we want to say yes to. So even if you're not investing in every one of these, which nobody would recommend you unless you're an LP, invest in everything you see. It's a great way for you to be building that database in your brain and helping you make that selection criteria. So I think just attending the demo days is very, and let alone building relationships and getting to know more people in the community. I think there's a lot of reasons that it makes sense to go to there. And often I will go and I'll see at least one or two. You have these impulse buys, it's
Yeah, I mean, there's one more I'll just mention, which is,
sure.
if people do have very specific interests, like this geography, this stage, this vertical segment, we do have a way to register those so that you get, emails about companies that fit that, not just in Chicago, but globally.
Yeah, it's a great point. I get those emails too asking if I want to update my preferences and such. Um, So I'm curious with just for you, like how did you first get interested in early stage investing? And did you do any angel before
Yeah,
Techstars?
I did. Yeah, when I sold my first company, I joined an angel group here in Colorado, and that group was, I would call it one of the old school, groups where, not a lot of investing was going on. It was, getting together and drinking champagne and eating tiny sandwiches and watching pitches and not a lot of investing going on. But I found one or two people that I co-invested in a couple of deals with, and so I probably was an angel in a dozen startups directly before I started Techstars, and I sort of got the hook was in. I got the addiction. It's nothing like my addiction today, of course, right? At the scale we operate at, but back then I was sort of getting a taste of it, and I always viewed angel investing as, if I can do this without losing money, I'll do it forever. That's awesome, right? Like give back to the community, support people, be around interesting entrepreneurs. I don't even need to make money. I just need to not lose money because I want it to be sustainable. And, the more and more of those deals I did as an angel, again, 20 years ago, less information was out there. There were less, great groups like this, right? It was people just trying to figure it out. It felt like a really hard way to go, right? To just basically, start a blog or something and say, hey, I'm an angel investor, and hope that you got good deal flow on your own. So again, that was sort of where it led me to feel like, oh, this is a little broken, right? I'm here in Boulder. It's 100,000 people. Like, how am I going to get deal flow, right? That's really meaningful. I got to build a network. I got to build bridges. I got to offer something to entrepreneurs that is a little different, right? A little more hands-on, a little more creative and valuable for them. And that was in the moment that, it turns out that, Y Combinator had just started. Techstars, obviously was starting. There were a few programs like Charles Rivers Ventures that did a quick start, $100,000 check after one quick meeting. I love that idea. And so, we're really just looking for a way to, as I mentioned earlier, grow the startup community here. Little did we know that we would get pulled all around the country and the world by other startup communities that wanted the model at that point. And we were being very open and sharing what we were learning. Folks like Accelerate Labs or Springboard in London were sort of using a similar model, and we were all collaborating together. And over time, right, we sort of turned that into a platform that you see today.
Yeah, I love that. So one of the big parts with writing early checks is I like to say when you're writing your first check, when you're writing a first check into a company, literally the first check the founder is getting, everything's going to change, but hopefully the problem and the founder. So for me, huge part of diligence is really diligencing the founder. So I'm curious how you think about diligencing founders at first check, first round stage.
Yeah, so for a little more context, right, we make an investment of a consistent amount of money. Right? So we're not negotiating anything. It's a consistent amount of money for a consistent equity position, and we do that across every investment we make every year through the accelerators, and that helps us you know, it self-selects with the audience too, right? That deal either works for someone or it doesn't, and they're not going to apply if it doesn't. So it sort of gives us those 20,000 applications I was mentioning. And then what we focus on there, the mantra has always been team, 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 market progress idea. Those six things, right, are what we look for. And the first three are team, to your point, Chris, right? What does that really mean? That they have some intrinsic motivation, they have all the requisite skills and talent, which by the way is changing a lot, right? What that means today. That they, sort of were put on this earth to do this thing, right? That they're called to it, and it's about something more than just money for them. Like I've seen plenty of startups work that really were just about the money, but I think you have a much higher chance of getting through the hard times if you actually care about the thing. So team, 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 like heavy focus on that. What are their skills? What's their intrinsic internal motivation? Why? What is their why? Why are they doing this? Followed then by market. To your point, what they're going to do is very likely going to change, but the market they're in is less likely to change. And next big sound, which some people on the call will remember from a long time ago, right, is the canonical Chicago example that came to Techstars, stayed in the same market, but worked on a completely different idea and sold it, had a nice exit after changing. So we look at the market, not too much at the specific thing. And then fifth is progress. I'm a strong believer. I'm pretty sure it's true at this point in my career that founders don't wait for resources. They just do stuff. They just make progress. They run through the brick wall. They teach themselves how to code if they don't know how to do that, or they learn vibe coding or whatever. They don't sit around and say, well, I don't have any money, so I can't make any progress. Right. And so we look for progress. And then I like to say idea at the end just because I like to make sure people know it's the last thing that we're thinking about. We know that's going to change. It's very rare we see a novel idea. It's more about the founders and the market and the progress. But the idea, sometimes surprises you and good bonus points for it, or there's good founder idea fit, right? And we look for that as well.
Those are great. Um, I'm a huge fan of the give first ethos that you, Brad, the rest of the Techstars community really embrace. Um, my first of four criteria that I look for when evaluating founders is giver in the Adam Grant give and take sense. I haven't yet heard another investor reference this criteria specifically, so I'm curious if giver comes into play in the way you and our Techstars think about founder selection. Why or why not?
Well, I think one of the core values and kind of the primary one we talk about at Techstars is this idea of give first, which definitely is not something we thought of or own in any way, right? We just try to live it, and uh, you know, it's more than just a hashtag on the wall in the kitchen, right? In the offices, it's a way that we try to behave with each other in the company, in a way that we try to think about our interactions with founders specifically. So it just means giving without any expectation of getting something back, right? It's non-transactional. Uh, Probably you're going to give something into the system that's going to be helpful to somebody else because someone did that for you. That's awesome. That's all you need. I don't think about it so much as one of the things we're looking for, probably because it's such a value, right? And it probably is just a natural filter for us, but I think it's a good one. It's not in my shtick when I read it out, but I think we're subconsciously looking for it because if someone is just coming to this network to take, right? Um, yeah, it's not that they can't build a successful company, but they're gonna feel a lot of friction, right, in the system from that. And so I think it's a good ad, and it's something that really I think differentiates the strongest and most successful startup communities that they have that spirit, that they are willing to take a call and just be helpful without needing to get something. I see that in Chicago. I love that culture. Open door, how can I help, and not a transaction.
I totally agree. And I think a lot of that culture that you refer to in Chicago is a result of a lot of the leaders that we have in Chicago and the founders that we've backed. And as their companies continue to grow and they take elevated roles in the community, it's a great flywheel, and that really that benefits everyone, in my opinion, especially the next generation that get the benefit from that.
Yeah.
Um, any flags that you see with founders and or their pitches that make you take a quick pass?
Sure. lots of them. I think probably the couple that I talk about the most are lying, extreme overpositioning. Those two are closely related. We're all marketers. Anything we're involved with, you know, we're gonna market it. We're gonna put it in a good light. I think that's all fine. But I'm pretty weary of extreme overpositioning, and I have zero patience for just being lied to. It's not the way I want to start a relationship, right? And that's true in life, and it's true in business. So that's a pretty easy one. A lot of founders that I've met with are just, they're not intrinsically motivated. They're not driven by something other than the money. That one for me is, it's not that they can't work, right? It's just, and I often tell the story. Our first fund was fortunate enough to be an investor in Uber at the angel round, so $4 million. I think it's 150 billion now. $4 million valuation, and I often say, like, I invested in Ryan Graves. And Ryan was the first employee. He was the original CEO. He was the guy I met, and he embodied the company for me. And he stopped by Techstars and mentored and gave me some great feedback on the companies. And I said, "Hey, what are you up to?" I don't know that I necessarily would have invested if it weren't him, right? There may be other people, right, that were involved with that company that had a different mindset or philosophy. Who knows? Maybe I would have. I would have been good economically, but it is so much about the people that I think I can admit to myself that really I was investing in Ryan, right? And that company has a lot of folklore around it about its own, culture and how it grew. But I think, it's so much about the people, and it's about the relationship with those people and getting that off on the right foot where they're willing to tell you what their problems are. And it's not everything is perfect. And, let me just tell you that somebody's investing when they're not. Like, those are the kind of flags that I just run away from.
Yeah, I just threw in the text chat, missionaries versus mercenaries. I'm 100% on the missionary
Yeah.
side. It's really important
You,
for
you
me.
say things more succinctly, Chris. That's good.
I don't think that's true. Spent a little bit of time thinking about some of this, but not in the same level that you do. Okay, so this is a little bit longer question, but this is really important for me, and in a big part of what the why is behind Lofty Angels. I'm very passionate about helping more people learn angel investing, but because I love it and because we need more first check angels. I recently shared with your friend Brad at the event that we had here in Chicago for the Techstars LPs uh, that we're giving special access to our Lofty founders to invest in their peers when we do syndicate deals. And it's already enabled 15% of our 180 plus founders to start learning angel by supporting each other by writing first checks, their own first checks. What do you think about helping founders learn angel before they exit? And what are the long-term ripple effects that we can that the broader community that can be felt by the broader community getting them involved as investors earlier?
I love it. And there's not enough of it going on in the world. We do a little bit of this in the Middle East, where we have content for angel investors that are, sort of curious or interested, and give them, a learning opportunity around it. I think founders specifically, figuring out a way for them to, even if they can't do it yet, right, to tag along in the process. Maybe they're not accredited yet or whatever, right? But they can still see and learn how it works, and they can shadow somebody. And, as they start to get liquidity, like, they're going to be the leaders of the next generation, right? And so, encouraging them around angel investing, or, however they want to invest, right? I think the thing that goes wrong is that, um, we don't talk to founders about this stuff, and they exit their company, and then they just go sail on a yacht around Hawaii and don't engage anymore, right? Like, we have to show them that, hey, this is what the community is doing for you. And, even if it's 1% of what you do, you should give that back in some way in the future. That could be as a LP in funds. It doesn't have to be as an angel investor. It could be in opening up a space, right, for startups to hang out in. There's a zillion ways to do it. But I love what you're doing there, and I think we need more of it in the world.
Yeah, and part of the idea too is it was shocking to me when we first did this with Techstars with AngelList 4 years ago. We decided to kill the carry and drop the minimum check down to as low as AngelList would take $1,000. And I said, who else is doing this? I'd like to collaborate and learn from them. And they said, we've never heard of this before. So we're going to try to open source that. And Brad and I have started early conversations around how we can, try to open source this more. But I'm really passionate about it. I think it's really important. The flip side of that too is a founder can have a huge exit and then say, oh, I got all this money now. I'm just going to start writing six-figure checks. And they have no idea what they're doing. They blow that. And then they go, I'm done. Like I made too many mistakes, burned too much capital. And then they just, maybe the LP or whatever. Not that it's bad LPing, but you certainly, if you're open to or angel curious, I want you to have a good experience so you continue doing it because we need more angels. Please, David.
The similar thing that I mean, it's adjacent maybe is the whole pledge 1% movement, right? Like figuring out how to get these founders aware of the impact of the thing they're building. In the beginning, you give 1%, you assign it through an organization like Pledge 1%, it costs you nothing. It's 1% of nothing. It has no value, right? But you've now built philanthropy into your culture, and all your employees know you're doing it. And when you do exit for whatever you exit for, right, 1% of that ends up going towards causes that you designate, right? It's a super easy way to build it in. But if you don't think about that and you're exiting later, right, and you get this high tax rate, like everybody's calling you in that moment, right? Because you just exited a company versus you built it in. So I think it's the same pattern in a different area. It's like get people aware of this early, get them doing it early, not late.
Yes, I totally agree with that. In fact, Lofty, in part of our ecosystem, we actually have 30 nonprofit partners that we work with in varying ways. And some of that is enabling our founders to start engaging with them without having to get solicited and get nickel and dimed for donations. So completely agree with that. So as we wind up here, I'd like to open it up to Q&A, but I've got maybe one or two quick last questions here. Any advice for how angels can help founders they back and anything they should avoid doing with founders? Just sort of like do's and
Yeah,
don'ts.
a couple of quick thoughts. Look, I think the most valuable thing most people can bring to the table is their own direct experience, which may or may not apply to the person you've invested in, as well as their network. And so, it's just the accessibility of like reading that email from that company that says, here's who I need to connect with and actually trying to help them do it. It's helping them with their agenda and what they're trying to do. I'm a huge believer that angel investors, uh, venture capitalists, and even board members really need to operate kind of mid-orbit, right? Not too close so that they're in the weeds and the details, and not too far away that they don't know what's going on. It's a phrase I heard the other day at FounderCon. Jim Franklin said it, and I thought it was exactly right. Like it's close enough to sort of know what's happening and what's the strategy, but not close enough to like be telling them what to do, or be so far away that you have no clue what's actually helpful to them. Just getting yourself to the right orbit.
Yeah, I think I can't remember if Troy coined this or if I did or sort of jointly, but I say the first rule of angel investing is do no harm. If the worst you do is hand them a check and never talk to them again, that's fine. Obviously, we'd love you to get more involved, but don't send them on wild goose chases or if they shut down the company, which many do, most do, unfortunately. Be
Yeah,
kind. It's really important. That's hard.
yeah, and they're not all going to work, and you're not in the driver's seat. You're trying to play a support role. I think that's the most important thing, and those are the best angels.
If you were to share just one critical learning to aspiring angels, what would that be?
Uh, wow. I think if you're new to it, and this is someone said this to me when I was just starting it, you know, pick a strategy and stick with it, right? Like get good at what you're doing, right? Versus like just, oh, that's interesting. I'm gonna put money there. Um, definitely don't do one or two deals, right? You've got to be diversified against this kind of opportunity. Most angels that do one or two deals, nothing works, right? If you're doing 10, 20, 40, 50, right, it's probably going to work, right, on some level, right? Because you're spreading out the risk, and the outliers are such massive outliers that it can pay for 50 or 100. The Uber investment I mentioned earlier has paid for every investment I've ever made, right? That one, right? So those don't come along very often. You've got to be in the game to get lucky in that sense, right? So come up with a strategy. Don't dip your toe in the water and then step back. You take an amount of money you're willing to put into the market, figure out how to, get exposure to a significant number of companies, 20, 30, 40 over time. And, that implies what check size you're then going to have. And then just stick with that approach and that strategy and you'll get good at it.
I think that's great advice. Troy and I did an Angel 101. We go through a little bit of how we talk about building portfolio. I'll throw a link to that video in the chat for anybody that's curious. Can't stress enough, portfolio theory is very important in angel investing. Okay, so we have some great questions. I'm going to throw a couple here. Um, David, you're clearly a big proponent of building strong startup communities. Based on what you know about us, any suggestions for how Chicago can better improve our growing startup community?
Um, I don't know that it's specific to Chicago, and um, I'm not, I have good knowledge of the Chicago startup community and broader entrepreneurial ecosystem, but I don't have as much as probably a lot of people on this call. Um, I'm a huge believer in community pride and sort of being loud. Um, right. And so, what's the rap on Chicago? Well, historically it's been, well, they're sort of not super into the latest whiz bang thing or consumer technology. It's more sort of enterprisey or whatever. But you have companies that are doing great in those other areas. And I think you could just imagine the rest of the country and the world going, oh, I don't know, I don't hear you. So that's your challenge. How do you let them hear you as a community, right? Where you are loud and proud and braggadocious about the things that are working. And, there's almost no limit to how much of that you should do, right? Or could do. I think one of the little hacks that Brad and I have always used is like nobody from Boulder goes to a startup event without talking about Boulder. Here I am doing it, right? We're all just really proud and happy about it and want to tell you about the companies that are in the community and so on. So, I would just say like no matter how loud you are, get louder, right? Promote the companies, promote the wins. It's not my win or your win, it's our win as a community. The rest of the world doesn't see you as a collection of 25 venture funds and a bunch of angels. They see you as Chicago, right? And so, sort of Chicago proud and making sure that the world is hearing about the great things that are happening.
A side note to this, everything we do with Lofty and just in general that I see in Chicago's community, I really think that we do a good job of keeping it fun because none of this we have to be doing. No founder has to start a startup. No first check angel has to write that check. So we want to make sure that we're enjoying what we're doing. And if you go to fun events, you're meeting good people. I think that's also another way to continue to push the flywheel. So just think about that. Like if you're not having fun, like why aren't you? Maybe we can figure out how to make these things more fun. Um, so this is sort of an interesting question. What are your favorite types of companies to invest in, and where do you see the most potential for growth in the next year?
I don't know that I have a favorite type per se. I would say I've had a lot of success with over the years sort of marketplace type dynamics in companies, which is one that I don't know if that's, attributed to luck or just, sort of the moment that the startups were happening. Infrastructure, marketplace. I think that it's a really interesting moment right now with AI. This is, one of the longest calls I've been on in a long time that we haven't mentioned AI yet. So I didn't want to break a record, thought I'd mention it. I think the infrastructure of that is what's really important. I think the moment that quantum computing enters, which Chicago and Boulder are both very involved with, and those things are put together, is a watershed moment for technology in general. It's just a completely new and different thing that disrupts essentially all technology, and that's a massive investment opportunity, right? And so I'm looking for like kind of the mega trends, I guess would be the word, things that are going to have impact over 10, 20 years, not the specific, vertical solution, that uses AI, but like what is it that is going to matter in say quantum computing, right? We need new ways for quantum computers to communicate. They're going to use entanglement, not fiber optics, right? So it's just a totally new set of infrastructure. We got to keep them cold, right? We got to do things like that. And data centers are going to be totally different. And so I like to think about, what can I do in the picks and shovels, right? The infrastructure that is sort of gonna win no matter what. And when I think back on the biggest companies I've been involved with, they've been like that. Um, Obviously with great people, with a lot of intrinsic motivation, all the other stuff we talked about.
Yeah, it's great. A little bit more on the operational side with Techstars. What do you look for when hiring your MDs and the teams around the country that you guys work with?
I mean, generally the pattern that has worked well for us, and the managing directors are the people that run the individual accelerator programs that we run around the world. Um, I was the first one. Troy, who was on the call earlier, if he's not still here, was one. Brad, who was on the call, right? These are the folks that are in the local markets, picking the companies, working with our investment committee. We're generally looking for someone that is sort of a generalist, startup coach, has seen a lot of different things, ideally some combination of both success and failure, because you learn more from failure than you do from success in many cases. So we're looking for that in their background. An entrepreneur that has the gravitas to sort of attract other entrepreneurs that want to work with them. Not really necessarily looking for someone with venture experience, right? Most angels don't have venture experience, right? They're learning as they go, and it's a teachable thing. And so, um, we're looking for entrepreneurs with strong networks, kind of the camp counselor type, generalist, good, strong, general business advice, good set of experiences, but not necessarily an existing venture capital person.
So sticking with a little bit of operational question here, um, what is the cadence of the programs and
Mhm.
how many companies do you accept per location? How do you minimize the feeling of competition across locations?
Yeah, so one of the things about our scale model that was very intentional was, we didn't want to have, 300, 400 companies in one building, one space, feeling like they're all just vying for attention. We wanted to have sort of, 8 to 12 companies a year in a community that got a lot of attention from that community, right? And got a lot of focus from that community and were the celebrated ones. And so, we look for 8 to 12 companies per class. We fund all those companies at the same time with the same deal. We take the same equity investment in those companies. We have a 3 month long or maybe slightly longer engagement where the program itself is helping them get the arrow pointed in the right direction, right? Take that idea and get it pointed where it needs to go, so that when you step on the gas, you don't end up 100 miles from where you're trying to go, right? And then there's a lot of focus on the storytelling and trying to help you build and raise capital. A lot of focus on customers and leveraging our network. Thousands of companies and thousands of mentors who want to buy and use this product early on. Want to give that company some momentum. So it's really filtering down, getting them in the program, executing this 3 month program, hoping they'll come out the other end with a really strong story, good set of customers, and ability to go and in most cases raise capital and go and change the world in some way.
Uh, so this question is very specific, and I'm going to post in the text chat. I got to find the video and I'll throw it in the text chat with our Angel 101. But um, one of the questions, how should an individual angel investor think about how much to invest in a given year or overall? Should there be an annual angel investing budget?
Yeah, I like that. I mean, I think taking, say, 10% of your, net worth, or maybe 5%, whatever's comfortable, and sort of going, okay, that's my thing I want, that's my chunk I want to do this with. Liquidity is a factor, of course, so you got to take that into consideration. And then saying to yourself, okay, my, 10-year plan is to, make at least 50 investments, right? Something like that, where you get that portfolio effect. Okay, what does that mean? Sounds like you're making about 5 investments a year, and you can figure out the amount of money because you're going to be consistent in your approach. You're not going to be like, wow, I really love this one. I'm going to put 4 times as much as I normally put. You're going to pick a strategy and stick with it. Be disciplined about that. So I think you could just do some basic math and 5 years down the road, you might say, oh, wow, I had a windfall. My 10% is now a different number. I want to increase my check size or I want to increase my frequency and I feel like I have bandwidth to do that. So, I think that's kind of generally how I'd approach it. And then, the other element of this beyond money is time, right? These companies are going to be updating you. They're going to have crises. They're going to need your advice. You have to have a way to manage that. You have to think about the scale you want to get to do that. It might imply bigger checks and fewer companies. I think there's danger in doing too few companies, as we've talked about. But I would just look at it as a percentage that you're willing to do this with. And, you can be honest with yourself about how that's going in 5 or 10 years, but it takes that long to know.
I love the idea of checking in too. Like give yourself a time, give yourself some parameters and then do that and then check in and then you can reevaluate. I threw in the text chat the Angel 101 video if anybody is interested. Um, Sort of an open-ended, interesting question. I'm angel curious. What's the best way for me to get started as an angel? I know that's super broad, but wanted to leave it open to your interpretation.
Um, I'll tell you what I did, and I'm a huge advocate of it, is there are probably people on this call. I'm one, Chris is one, there's probably many others. Troy was here that are, very experienced with this, make lots of investments, and you just need to go to them and say, I would like to co-invest with you in the next deal you do. Like, you can still say no if you just don't like the thing or you don't like the people. But just using that as your quick and easy win, if you said to me, that's what I want to do, I'd say, no problem, I'm going to call you next time I do a thing. Right. And most people would do the same thing because that's adding value to the portfolio companies they're investing in. So rather than, just sort of trying it on your own, try it with somebody really experienced. The first angel investment I ever made was probably 4 or 5 years before I met Brad Feld, but he was one of the co-investors in that deal, and that gave me comfort. I didn't even know him at the time. I was just like, oh, Brad's in this. Okay, like he's done this before. So, it's a apprenticeship model, right? Like just tag along with people that have done it, ask them questions. We're all really happy to say, yeah, here's what we've learned and try to share our experience. And by doing, you learn. I literally called the first check I ever wrote. It was a $50,000 check in a company called Solidware. That company would later sell, and I think I got a 2 or 3x on it, something like that. I literally called it tuition. That was how I referred to it. I'm just learning.
So much of this, I mean, I wrote my first angel check 27 years ago when I was 23, learning every day. So if you're curious and you want to learn, this is a great way to do it. That's a great
I,
explanation.
I'd encourage you, Chris, to have a list of people in your group that are willing to do that, right? That people could say, "Hey, I'd like to be in the next deal you do." I think it'd be an
That's
awesome ad.
it's a great idea. And again, that is David didn't directly say this when he was saying how much time you're going to need to allocate for thinking about evaluating deals, getting deal flow. Part of it is also just build like an enormous amount of my time is having conversations with people like David, building relationships with potential co-investors that then give you deal flow, and then vice versa. Because as I get companies that I've written checks to, I want to share those deals with as many people as possible because it is in everybody's, especially my best interest for those rounds to be full. So you really do want to be allocating some amount of time to building relationships with co-investors, both for learning, for sharing your deals, and getting deal flow from them. All very important. I think we've got maybe time for one or two more. Um, could you talk through your investment thesis related to underserved markets like Boulder, Chicago, et cetera? Is this a high upside bet or a more frequent hit rate?
Yeah, one of my motivations, I told you for starting Techstars was to make this startup community stronger here. And then we got pull from so many startup communities that were trying to do the same thing, right? Where we were like, hey, we can do this together and the network is better if it's more global. Um, I think it's sort of the, bigger fish, smaller pond sort of analogy, right? If what you're doing is going and hunting in the same place as everybody else, that's going to drive prices up and make deal flow difficult to access. Um, it's one of the reasons we kind of institutionalized a reasonable amount of money and a reasonable price point for the accelerator. That it turns out that $250,000 is plenty for a startup to prove they're there or not, right? And I actually love it when they get to the end of the program before they raise more money because, sometimes they'll take money from Techstars and then they'll add on some angel investment right away, and maybe they have more money than they need to sort of prove that there's a there there. So I think you can get uh, more access to deals in smaller markets. I think the pricing is going to be more stable and reasonable versus getting run up because there are so many people trying to get in it. And I'm very disciplined about pricing as an investor. I don't want to chase, valuations. There's plenty of good deals to do. My job is to make sure every deal I'm in is really good, not that I'm in every good deal, right? So that's a subtle difference. Um, and yeah, so it's a deliberate strategy. Now, when we started in New York was not nearly the startup community it is today, and it's more of a challenge today there, right? But it turns out again, you pick a strategy, you stick with it, you get really good at it. There are still going to be people that need that thing in the community, right? So that's what we're seeing even in New York and Boston, San Francisco, where we do operate.
Yeah, completely agreed. Okay, so there's still other great questions in here, but I'm going to ask one that I'm really uh, very curious about. And I know you're not supposed to have favorite children, so this isn't a favorite children question, but you've been investing for a really long time. Any interesting stories or highlights, or maybe an amazing founder or something you'd like to give as an example for angels to think about?
Um, Sure. I like to talk about very underestimated, founders, and the one that I like to talk about is this guy named Isaac Saldana. He started a little company called SendGrid. I was on his board from the accelerator through his IPO, and he was too, even though two other CEOs had come along in the intervening period. So he stayed engaged the whole way. Isaac immigrated from Mexico. When he was young, he, was very, very geeky. I guess is the right, which is I view as a good word. He loved email. He loved transactional email. He loved SMTP protocols. He loved all this stuff in a way that is hard for any of us to understand. And he created a company around it. And, the culture that he created, 4-H culture, a hungry, honest, humble, I can't remember the fourth one, hardworking, something like that, healthy, was just so deeply embedded, right, in the company he built. And if you would have looked at him coming out of the accelerator, like everyone did, every venture fund did, and every venture fund passed. The only funds that would do it were the people that were running the program, right? Like I did it. Mark Solon, who was very involved, did it. We did it at a very low price because nobody else would do it. Um, everyone passed because Isaac was just, he would stand on stage and you just go, well, that's not a CEO. It just doesn't feel like that. But he's super deep technically and he's built an interesting thing that's kind of working. And so someone just needed to give him a chance, right? And he went and recruited the CEOs that would scale the thing deliberately and intentionally, right? Because he was really the tech guy. And now he's, older, more mature. He's investing around the ecosystem. He's, stronger, more capable CEO for it all. But, I love the underestimated underdog stories, and that's a great one from my history.
Yeah, that's an awesome story. It will lead to a little bit of my conclusion and closing here. First of all, thank you, David. This was really, really great. I appreciate taking the time. I know you're feeling a little under the weather, so thank you for bearing with us. It was I learned a lot. I'm sure everybody that's listening live and the people that are listening now recorded as well will take a lot from this. A huge part, two big themes that I think are really important is as an angel, we need to think about like signal. So if I write a check, when I come in as a first check, and probably about a quarter of the checks that I've written are actually first check, it does give signal to other people in the community. Oh, Lofty's in. Chris has made an investment in this. Like that helps. Getting your first check is definitely one of the hardest points. But just because you don't see somebody else who took that first step doesn't mean you should overlook that founder. And this is a great example of that. If you have conviction, don't be afraid to be that first check. Don't be afraid to be the trailblazer. But also know that a lot of those first checks or any of your checks are still going to go to zero. So you can't read into those 100% because, oh gosh, I should have been following somebody else. This is a team sport as angels. We do look for what are our peers doing, what are other VCs doing, what are maybe bigger brand angels doing, but we can't also just rely on them to make our investments. We have to at some point build our own conviction, and maybe that's a little bit later as you go along your career. But I think that's such an important point. I can't tell you how many stories I've had where I've literally walked founders into QB is my favorite example. It was so hard for them to raise more capital, and they ended up making a very substantial business that they own most of the capital for. That was a lucky scenario. Most of the time you just run out of capital because you don't have enough, but they were able to really grind it out and have a fantastic exit for themselves. So anyway, I think that's an important theme. Overall, whole purpose of these, again, just to reiterate, these are opportunities for you to learn more about angel investing from people that have been there and done that. And we hope that you partake in more of these opportunities that we have, whether it's ones that will be recorded and archived soon on loftyangels.com, as well as the events that we do, like the Lofty Angel Summit in the summer. So please be a part of our community. And we will hopefully have many more opportunities to learn together, and hopefully much more co-investing in the future as well. And please share this community with other people too. This is not something we're trying to monetize. It's literally just open sourcing angel investing experience to build more angels. So with that, thank you, everybody. Really appreciate all of your time.